Have you noticed that your hard-earned money is slowly slipping away before it even hits your bank account? If you live and work in Canada, you need to pay close attention to your next few paychecks. A series of massive tax updates implemented for 2026 are actively shrinking take-home pay for millions of working Canadians. This isn't just a minor adjustment or a few pennies lost to inflation. This is a structural shift in how the Canada Revenue Agency calculates mandatory deductions. If you are earning a middle class or upper middle class income, the numbers on your pay stub are changing, and definitely not in your favor. To understand why your wallet is feeling lighter, we have to look directly at the automatic deductions pulled from every single pay cycle. For years, Canadians have been watching the multi-year enhancement plan for the Canada Pension Plan unfold. But this year in 2026, the thresholds have reached an entirely new peak. While the base contribution rate stays at 5.95%, the federal government has raised the maximum pensionable earnings ceiling significantly. The maximum cap has been pushed up to $74,600. This means that if you make anywhere near or above that amount, your standard contributions will max out at a painful $4,230.45 for the year. That is hundreds of dollars extra being deducted directly from your regular pay cycles compared to previous years. But the real hit for middle and high income earners comes from a secondary tax layer that many Canadians still do not fully realize has expanded. It is called the CPP2, or the Second Additional Canada Pension Plan Contribution. This second tier specifically targets your earnings above that initial threshold. For any income you make between $74,600 and the upper ceiling of $85,000, the government is tacking on an additional 4% flat deduction. This change alone adds up to an extra $416, sliced right out of your annual take-home pay. If you are a corporate professional, a senior tradesperson, or a tech worker pulling in a solid middle-class salary, you are hitting this exact zone, meaning your payroll department is legally forced to withhold more cash from your earnings. It does not stop at pension contributions either. Employment insurance premiums are also shifting the math on your paycheck. The employee EI premium rate stands at 1.63%. However, the government has increased the maximum insurable earnings limit to $68,900. Because the ceiling is higher, the total amount of money subject to EI deductions has expanded. The result is that your annual maximum EI premium has climbed to $1,123.07. When you combine the maximum regular CPP, the maximum secondary tier CPP2, and the updated employment insurance premiums, the total mandatory payroll deduction for an individual worker climbs toward nearly $5,800 a year. That is thousands of dollars completely gone before you can even pay your rent, buy your groceries, or cover your mortgage. Beyond these pension and insurance adjustments, the overall progressive income tax system continues to redefine what it means to be a taxpayer in Canada. The federal government sets the lowest tax bracket at 14% for income under $58,523, which offers a base level for lower income tiers. But the moment your career progresses and you cross into the next brackets, the progressive tax system begins to take a massive bite. Income between $58,523 and $117,045 is taxed at a federal rate of 20.5%, and anything above that scales rapidly to 26%, 29%, and eventually a crushing. Keep in mind, these are just the federal rates. Your employer also has to deduct provincial income taxes, which vary heavily depending on whether you live in Ontario, British Columbia, Alberta, or anywhere else across the country. As inflation pushes nominal wages higher, more average workers are being pushed into these higher brackets, experiencing a phenomenon known as bracket creep, where a raise on paper does not actually translate to more wealth in reality. All of this leaves the average Canadian worker in an incredibly difficult financial position, with the cost of living remaining stubbornly high across major Canadian cities. Watching your net take-home pay shrink feels like a losing battle. Your payroll department isn't making a mistake when they print your pay stub. They are simply following the strict payroll formulas handed down by the government. It is more important than ever to look closely at your line-by-line deductions, map out your actual net monthly cash flow, and adjust your personal household budget to accommodate these hidden drains on your income. If you want to stay ahead of these financial shifts, understand where your hard-earned tax dollars are actually going, and discover hidden strategies to protect your wealth from shifting government policies, you need to stay informed. Make sure to hit that subscribe button to Canadian Finance Hub with James right now. We track the hidden economic changes, the breakdowns of our complex tax systems, and the crucial financial updates that the mainstream media completely overlooks. Don't let your hard work vanish into the system. Subscribe to Canadian Finance Hub with James today. Keep your eyes on your money, and I will see you in the very next video.